Hello and welcome to today's session. Today, I'm going to talk about accounting and tax compliance issues faced by GP practices. It's probably not the most exciting topic, but it's very important nevertheless. Just to introduce myself, my name is Elena Bytch, and I'm a tax advisor and an accountant at Prism Accounting. Our firm specializes in servicing clients in the medical industry, and specifically, we work with a lot of doctors and GP practice owners. Just a quick legal disclaimer before we kick off. All the information provided in this presentation is of general nature and does not constitute tax, legal, or financial advice. It does not take into account your personal circumstances and is not intended to replace a consultation with a qualified professional. This session is also not designed to be particularly comprehensive, but it should give you a good broad overview of certain issues that I believe you should be aware of. And the first such issue is your employment obligations. And specifically, I wanted to focus on super guarantee obligations. So GP practices may employ nurses, may employ a practice manager, administration staff, even registrars. And some practices even have doctors working as employees. It's probably a less common arrangement because doctors are usually working as either independent contractors or independent providers under service agreement, but we still see practices sometimes employ their doctors. And as you are probably aware, if you employ someone, you are required to pay superannuation contributions on their behalf to their super fund. And it applies to all employees, whether they are full-time, part-time, or casuals, who are over 18 years of age. And it used to be that if a particular person was earning less than $450 a month, then they were not eligible for super contributions. But now this threshold has been removed, and now all employees are eligible for super contributions. If you have employees under 18, you are required to pay super guarantee for them if they are working for more than 30 hours in any given week. Also, if you have non-arm's length employees, for example, company directors or family members working in your practice, you are also required to pay super contributions for them as well. And it's important to note that sometimes contractors are deemed to be employees for super guarantee purposes, and then they are also eligible for super contributions. The definition of employees is actually different to a definition in fair work legislation, for example. And certain contracts can fall under this definition. So if doctors are working in your practice as independent contractors under their own ABN, it doesn't necessarily mean that you can avoid super guarantee obligations. Now, if you engage doctors operating through their own company, then you are not required to pay super contributions for them. It's because only natural persons can be employees for super guarantee purposes. And in this case, their company becomes responsible for meeting super guarantee obligations in respect to those doctors. And as directors of their own company, these doctors may even be personally liable if the company fails to meet their super obligations. So if I was advising a doctor, I probably wouldn't advise to contract through a company. So is a contractor deemed to be an employee for super guarantee purposes? We need to look at the legislation. What does it say? And it says that if a person works under a contract that is wholly or principally for the labor of the person is an employee for the other party to the contract. So when we say wholly or principally for the labor, it means more than 50% of the dollar value of that contract relates to their labor. Also, the factors that can indicate that the person is an employee include that when the person can't delegate their responsibility to anyone else if they need to perform their responsibility personally. And also when their remuneration is not dependent on achieving a particular result, but when they're paid, let's say, based on hours worked. It should be noted that practices may be required also to pay super guaranteed contributions for doctors engaged under service agreement as well. And I put quotation mark around service agreements because the contract may be labeled as service agreement, but when we look at the facts, the true nature of that contract may be that it's not a genuine service agreement. And there was a case recently where practice was found liable for super guarantee contributions for the practitioner involved in the practice, and it was a dentist working in a dental practice, but the case is equally applicable to GP practices as well. So it was a dental corporation and Dr. Moffat's case. In this case, dentist sold his practice to dental corporation, and he was subsequently engaged as an independent contractor practicing under what they called service agreement. And he worked there for a number of years, and after he resigned, he actually claimed that the practice was liable for super contribution for him. And he eventually sued the practice for their super contribution, for his super contribution. I should point out that under the terms of that agreement, dental corporation didn't really have control over his practice, so they didn't exercise control and didn't control him as would be the case with contractors. But he was essentially required to ensure that the practice maintained minimum cash flow, and he was also required to provide some management services to the practice. And when the court looked at the totality of this arrangement, they concluded that Dr. Moffat was an employee for the purposes of Super Guarantee Act, as the contract was wholly or principally for his labor. So once we determine who is covered under super guarantee obligations, we then need to calculate your super guarantee obligations correctly. So how is super guarantee calculated? So it's basically super guarantee rate multiplied by ordinary times earnings. And ordinary times earnings may include salary, allowances, bonuses, any commissions, director fees, etc., if these payments were earned during ordinary time. So there is no obligation to pay super contribution on your overtime earnings. So if someone works overtime, you do not have to apply a super guarantee rate on these earnings. And also if someone earns more than the maximum super contribution base, you don't have to calculate super guarantee obligation on the excess of that amount. So, for example, in 2023, the maximum super contribution base is $60,220 per quarter. So if someone earning more than that amount, you need only to calculate super guarantee on that amount. And as you are probably aware, from 1st of July 2022, super guarantee rate increased from 10% to 10.5%. And the rate is actually determined based on the time of payment, not when these payments, or when these salary and wage or other payments were earned. So if someone was earning this amount before 30th of June 2022, but if the payment was made after 1st of July 2022, then you need to apply a new increased rate of 10.5%. So when is your super guarantee due? It's basically due by the 28th day following the end of the quarter. So for example, for the quarter ending 30th of September, your super guarantee payment is due by 28th of October. And it should be noted that super guarantee is only considered paid when it's actually received by the super fund. It's not when you process the payment, it's when the payment is received by the super fund. So if you pay it late, you will need to pay it as a super guarantee charge. It's no longer a normal super contribution. It's a super guarantee charge. So then you need to lodge the super guarantee charge statement to the ATO as soon as possible. And you need to pay the super guarantee charge, which consists of the shortfall amount itself, plus any administration fee and any accrued interest, which is accrued on the liability. And you need to pay it to the ATO. And it should be noted that super guarantee charge is actually calculated on gross earnings. It's no longer ordinary times earnings, it's total earnings. And if you fail to lodge the statement and pay super guarantee charge, penalties of up to 200% can apply on that amount. And it should be noted that super guarantee charge and penalties are not tax deductible. So if you pay it late, it's as I said, it forms part of super guarantee charge, and it's no longer tax deductible. Now, the ATO has power to remit penalties, but not the super guarantee charge itself, because it's a liability arising under Super Guarantee Act, and the Commissioner doesn't have a power to remit it. And it's also important to note that there is no time limit applicable for recovering unpaid super, so they can go back as many years as they can and recover super. So and it's really important to ensure that your super guarantees are paid on time, because if practices systematically fail to pay super, and they do it for a number of years, the compounding effect of all of these can be quite disastrous. And especially with the ATO data matching and single touch payroll reporting, it's only a matter of time until non-compliance can be discovered. So it's really important to remember that. Now, the next issue I'm going to focus on is your payroll tax obligations. So it's quite a hot topic at the moment, especially for medical practices, in light of recent cases. So you are probably aware of that recent case in New South Wales, Thomas and Naaz, where it was found that payroll tax was payable in respect of payments made to independent GP practitioners who were practicing under service agreements. And we will discuss it in a minute. So what is payroll tax? It's basically a state-based tax. It's not a federal tax, it's a state-based tax. And this tax is payable on wages to employees if the total amount of those wages exceeds certain threshold. So for payroll tax purposes, wages generally include wages and salaries to employees, any allowances, bonuses and commissions, director fees. They also include the actual super guarantee contributions as well, and also any amounts of salary sacrificed paid to super funds. And if you provide any fringe benefits to your employees, this fringe benefit should be grossed up for the purpose of payroll tax calculations. And also payments to contractors are also included in wages for payroll tax purposes, unless certain exemptions apply. And as I said, each state has its own legislation about payroll tax, but the key provisions of each payroll tax act, they're quite similar in each state. And if you have several practices in one state, or if you have practices operating in different states, you should also consider grouping provisions, because they might also apply in your situation. So what's the problem with the payroll tax in medical practices? We discussed that doctors are often working under service agreement, and they are considered to be independent providers. They are not considered to be employees in a traditional sense, for example, for the purposes of employment legislation. They are not considered to be employees, but for payroll tax legislation, they sometimes can be regarded as employees. And it really depends on the terms of each individual agreement, because in recent cases, practices were found liable for payroll tax in respect of certain payments made to such practitioners, because it was found that the practitioners, by providing services to their patients, they also provided services to the practices. And the cases I'm talking about is optical superstore, which is about optometry practice. And another case was quite recent, which is Thomas and Naaz, and we heard an appeal recently, which was unsuccessful. And in this case, it was found that the practice was liable for payroll tax. So what does service agreement entail? So this diagram illustrates typical service agreements. So we have a number of doctors basically signing a contract with the practice to work under service agreement. And under this agreement, and under normal service agreements, the doctors are providing services directly to patients. They are not providing services to the practice. So the red arrows, they indicate the provision of services in this diagram, and blue arrows are basically collection of payments or making payments. So under this service agreement arrangement, the practice contracts to provide certain services to the doctors in exchange for service fee payments. So the practice might provide premises, equipment, IT system, administration services. It might employ non-medical staff as well, provide marketing services to the doctors. So it's basically looking after running the practice while doctors are focusing on providing services to their patients. And often practice collects fees on behalf of these doctors from Medicare, from health funds, or from patients directly. So as I mentioned, under this type of arrangements, doctors are regarded as providing services to their patients directly, and they are not providing services to the practice. But instead, it's the practice who provides services to the doctors, which can be contrasted with normal contractor agreement, where doctors are engaged by the practice to provide services to the practice, and then the practice provides services to the patients, which is different arrangement. Okay, let's consider this recent case in New South Wales, Thomas and Naaz. In this case, the judges had to analyze the terms of the service agreements to determine if the practices were liable for payroll tax in respect of payments they made to the doctors who were practicing under service agreements. And these features of the agreements were particularly relevant in reaching the judge's decision. Now, first of all, the doctors had certain rostering commitments. They had to sign in and sign off for each shift, and they also had to work 5 days a week and meet their weekend rotation requirements. If they were planning to be absent, they had to give an advance notice to the clinic, and their absences had to be approved. The records of all the services the doctors performed were sole property of the clinics. So the doctors did not have ownership of their own patients' records. Also, they had an obligation to promote interest of the clinics by not channeling patients away from the clinics. And there was a requirement to abide by clinic operating protocols and complete all necessary documentations. Also, doctors had an obligation to bulk bill their patients, so they did not have control over their billing model. And what's important, the doctors were also subject to restrictive covenants, which prohibited them from practicing anywhere within 5 kilometers of these clinics for a period of 2 years after leaving the practices. And based on the totality of these arrangements, the judges made a conclusion that these doctors were employees for the purposes of Payroll Tax Act. It's because they not only provided services to their patients, but by doing so, they also provided services to the practice. I have summarized certain risk factors that you need to look out for if you want to minimize a risk of payroll tax exposure for your practice. So if you recognize any of these factors in your arrangements, it's a good idea to review your arrangements with a lawyer and also a specialist accountant who is specializing in looking after medical practices. And these risk factors include certain contractual terms. I'm not going to run through these points because we already considered these factors when we looked at Thomas and Naaz case. There can also be some operational risk factors, including when the practice is invoicing patients using its own ABN. Patients always have to be invoiced using doctor's ABN, not the practice ABN. Also, it should be noted that in Thomas and Naaz case, the payroll tax was imposed only on net payments of fees that the practice collected on doctors' behalf. Some doctors in this case actually preferred to do their own billings, and these payments did not attract payroll tax. So when doctors' billings are paid to the practice account, it can be problematic. Sometimes this cannot be avoided because sometimes it's just your business model that you process payments for doctors. And if that's the case, you need to minimize other factors. So if you're in a situation where the billings are processed in practice bank account, make sure you have a separate account for these purposes to process doctors' billings. Do not mix it together with all other practice income, which is really, really important. Also, when doctors' billings are recorded as practice income in accounting records, it can also be problematic. So in Thomas and Naaz case, this factor wasn't particularly relevant to determine whether the practices were liable for payroll tax, but judges did consider these factors when they were deciding whether to impose any penalties. So yeah, make sure that your records are consistent with your contractual arrangements. Also, from a marketing perspective, when you are referring to doctors as our doctors or our team, either on your website or marketing materials, it can also be problematic because it's the totality of the arrangement that is important, and the relevant factor could be that, how your arrangements are perceived by third parties as well. Speaking of the accounting treatment, Let's look at this example to illustrate the differences between contractor agreement and the service agreement. In this example, we have total patient fees collected for a particular period of $100,000. And we have a 60-40 split. The doctor gets 60% and the practice gets 40% of the total fees. If we have a doctor working for the practice as an independent contractor, the doctor is taken to provide the services to the practice. And in turn, the practice is providing services to the patients. So in this case, all the patient fees will be practice income and will be shown as income in profit and loss. In this case, it's $100,000. And our profit and loss should also show contractor expenses of $60,000. When we have a doctor working as a contractor and when the doctor is registered for GST, we need to pay GST on the fees we are paying to the doctor. So in this case, our balance sheet will show GST paid of $6,000, which is 10% of that amount. So it will be sitting in assets for the practice because it will eventually be collected from the ATO. So the GST doesn't really make a difference for us. When the doctor is working under service agreement, the doctor is taken to be providing services as independent practitioner to his or her own patients. So not providing services to the practice, but providing services to patients. And the practice is providing services to the doctor. So in this case, we are showing our service fees as income. So this is service fees being the net payable to the practice, because this is something that doctor is considered to be paying to the practice for provision of services. And we should also be showing GST collected on these total fees being 10% of these amounts, because the doctor will be required to pay GST on top of these fees. So when you have this situation, when you have doctors working as independent providers, patient fees should never be shown as income of the practice. And also, if you collect fees on doctor's behalf, these fees collected should not be shown as assets of the practice as well. So let's move to the next topic, being allocation of profit in medical practices. GP practice profitability largely revolves around provision of personal services by GPs. And the ATO is concerned that the individual providing these services may not be returning adequate proportion of their income in their own hands, and instead diverting this income to some other entities or some other people to facilitate tax minimization. Let's first of all consider the concept of personal services income. What is personal services income, or PSI for short? Basically, it's income generated mainly from personal skills, efforts, or expertise. And when we say mainly, we mean more than 50%. So to determine if the income is PSI, the question we need to ask is more than 50% of the market value of that particular invoice or contract relates to provision of personal efforts or skills or expertise? If the answer is yes, then it is a PSI income. If the answer is no, if the income is generated mainly from sale of goods or use of assets, for example, premises or equipment or business structure, then it is not PSI. So once we determine that the income is PSI, we need to see if we pass certain tests, because otherwise the PSI income will be treated under certain provisions of the Income Tax Act called PSI regime. And I'm not going to go into details about these tests, but I'm just going to say that it's easy for doctors to pass these tests because they can either pass a result test or unrelated clients test, because they mostly work with unrelated clients, being their patients. So if we fail these tests, then PSI regime applies. And that means that we can't claim certain deductions, which otherwise are not available to employees. We can't claim payments made to our associates for doing administrative work or any other non-principal work. And we need to attribute this income under attribution rules. So all the income collected under the company, for example, has to be attributed to individuals. So these are just some requirements of the PSI regime. And the common example where the doctor might fail PSI tests is, for example, a locum doctor contracting with one or more practices. If we pass PSI tests, we are not subject to PSI regime, but we are still subject to general anti-avoidance provisions, being Part 4A provisions. And that means we can't split or divert this income. The fact that we pass PSI tests does not mean that income is no longer PSI. It is still personal services income, and it can't be split or diverted. And it must be taxed to the practitioner who generated this income. In this scenario, we can have a spouse working for us, or we can even have a service entity and claim certain deductions, but the rest of it has to be returned and under the name of the practitioner. If the income is not PSI, we are allowed to split it. However, if it does involve certain PSI component, for example, if a doctor generates certain income, so a certain portion of this income, we still need to ensure that we pay market value of remuneration to that individual who provided these services. So in regards to PSI income, the ATO is concerned that income earned from rendering of personal services of practitioners is not appropriately taxed to these practitioners. And the practitioner might be using some business structure to alienate PSI to companies, trust, or other individuals. And they also can manipulate timing of income, for example, by using a company to retain the profit and paying it in the following year, which is not allowed. Also, it might involve paying excessive remuneration to family members to split income, or use of service entity arrangements where there is no commercial reasons for it, or if the service fees payable to the service entities are particularly excessive. So let's consider service entity arrangements. We already considered an example where doctors were working for a practice and the practice acted as a service entity. And in this example, we consider example where doctors who are working in the practice are actually equity holder of this service entity of this practice. So in this example, the service there is a service entity and there is a practice entity. And in this example, doctors decided to provide services through a corporate structure, which acts as a practice entity, and we call it Medical Practice Pty Limited. And we also have a service entity. And in this case, it's a discretionary trust, but it can also be a company, it can also be a unit trust, depending on your needs. So discretionary trust is very common in family practices where all the doctors are members of the same family. And in this case, we are illustrating that the practice is paying service fees to the service entity, and the service entity in return is providing the main practice with certain services, being maybe premises, maybe it takes care of the leases, provides equipment, pays certain running expenses, handles practice administration and insurance, and it might employ administrative staff, bookkeeping staff, takes care of the recruitments, and provides market services. So these are common services provided by service entities. So speaking of this situation where doctors generate fees through corporate structure, they need to return these amounts, the fees generated by them to themselves, because otherwise it would be considered tax avoidance. But they also pay, the entity pays service fees to the service entities, and that payment represents allowable deductions to the practice entity and consequently to doctors. And the fees payable to service entity represent income of the service entity. And then when we deduct all the expenses in the service entity, we have a certain profit sitting there. And our service entity is a discretionary trust. So the trustee of the trust has a discretion how to distribute income among the beneficiaries. So this is just a common example of service entity. But the ATO is concerned whether the service entity is tax compliant, basically, because, as I said, the service fees might be excessive, or there might be no reason for a service entity to exist. It doesn't really run, it doesn't really help running the practice. So just to consider whether your service entity is tax compliant, you need to follow 2 steps. And these steps are actually described in the ATO's publication, being service entity arrangement. And I encourage you to check out this publication. So the first step is we need to determine whether we have commercial benefits. So can you explain how the service arrangement helps you run your business? Does it give you access to staff, resources, IP, etc.? Does it relieve you from responsibility of performing certain support function? Does it relieve you from certain risks and certain financial and legal obligations, for example, for ensuring that all the payments are made? And if it does, if it does help you run your business, run your practice, then we have to consider step number 2, whether the level of service fees are appropriate. So there are a number of methods available to calculate service fees. They include indicative rates, comparable market prices, or comparable profits. And the ATO's approach for GP practices is slightly different. So the ATO accepts that service entities in GP practices can charge fees of up to 40%. And if the fees are 40% or less, it's quite a low risk of non-compliance. And they're saying that for rural practices or for solo practitioners, the fees can be up to 45% without being without involving high risk of ATO audit. And this is because rural practitioners or solo practitioners might have expenses which are higher compared to all other practices. And again, these percentages might not be appropriate if your service entity is not providing full range of services that otherwise would be expected from the service entity. And in this case, you need to refer to all other methods available in this publication. So the next thing I want to talk about is a practical compliance guideline recently issued by the ATO about allocation of professional firms' profits. These guidelines gives you a risk assessment framework, basically, to help you identify the degree of risk that the income earned by individual professional practitioners is not appropriately taxed to these practitioners. And this PCG, or Practical Compliance Guideline, uses traffic light system to assess your degree of risk. So if you determine that you are in a green zone, the risk is very low, the ATO will only apply compliance resources in exceptional circumstances, or if they want to verify that your arrangements are in fact a green zone arrangements. If you are an amber zone, the ATO is likely to conduct further analysis and may contact you to understand your arrangement and resolve any areas of differences. If you are in a red zone or high risk, it means that the ATO will conduct further analysis on the facts and circumstances of your arrangement as a matter of priority, and they may proceed with audit if it's appropriate. So let's look at this risk assessment framework. First of all, before you even apply this risk assessment framework, you need to pass two gateways. I'm not going to talk about these gateways in too much details. Let's just say that the gateway one is that you have to have commercial rationale, meaning that you must be able to demonstrate that this arrangement helps you run your business better. The second gateway is absence of any high-risk features, and the examples include related party financing arrangements under non-arm's length terms, or if you use certain classes of shares to distribute profit to non-equity holders. So they are not very typical of this, of normal GP practice conduct. Once you pass these two gateways, then you need to assess your risk against three factors. The first and second factor are compulsory, but the third factor is optional, and because sometimes it's really hard to apply. And then you compare your results to this table to determine your score, and then you basically need to determine based on your score whether you are in a green zone, amber zone, or red zone. So what you should know about these practical compliance guidelines is that they apply to all professional practices, including GP practices. The guidelines apply from 1st of July 2022, and the ATO is expecting you to assess your risk on an annual basis. The PCG is not law, because the ATO does not make law. And it's also not tax ruling, it's not interpretation of the law, but rather they are designed for the ATO staff to assess how they should apply resources to ensure that you are compliant with tax law. And they also provide you guidance on how the ATO will assess your risk as well. So you can use it for your own advantage as well to assess your arrangements. If you are in a high risk zone, it doesn't necessarily mean that you are not tax compliant. There could be good reasons for it. But if you do have reasons and you are in a high risk zone, it's very important to keep enough evidence to substantiate your claim. And it's also remembered that this guidance do not apply to PSI income. So if you have PSI income, it needs to be returned in the hands of the practitioner. And the last issue I'm going to cover today is goods and services tax in GP practices. You're probably aware that medical services are GST-free, but to satisfy the definition of a medical service, the service needs to satisfy either of the two limbs of this definition. So the first limb is, it should be a service for which a Medicare benefit is provided. Once we've satisfied that the Medicare benefit is provided for a particular service, we know it's GST-free. We don't need to consider any other factors. But if Medicare benefit is not payable, then we need to consider the second limb of this definition. And it says it can be any other service supplied by or on behalf of a medical practitioner that is generally accepted in the medical profession as being necessary for the appropriate treatment of the recipient of the supply. So when we say provided on behalf of the medical practitioner, what do we mean? So there are certain requirements, and basically it needs to be billed in the name of that medical practitioner. And then it has to be part of the service the medical practitioner provides. And the practitioner also needs to be involved in provision of that service. So, for example, if a nurse is supplying services as part of GP treatment, nurses' services will also be GST-free. When we say appropriate treatment, it has to be done either to assess a patient's health or work out a course of action to preserve, restore, or improve the patient's physical or psychological well-being. And it has to be accepted by the profession as being appropriate for the patient. And sometimes it is subjective, because what's appropriate for one patient might not necessarily be appropriate for another patient. The services also, the recipient of the supply must also be the one receiving this treatment. So if it's supplied to someone else, it doesn't satisfy the definition of medical services, and it might not be GST-free. So, for example, speaking of a medical report, are they GST-free or not? First of all, we need to consider if Medicare benefit is payable. If it is GST-free. But if it's not, we need to ask if the report is provided as part of the patient treatment. For example, report might be provided by pathology to a GP practitioner for treatment of a patient, and then it would be GST-free. But otherwise, if it's not for treatment, it's not GST-free, irrespective of which party the report is provided to. For example, if a patient is commissioning a report for the purposes, for example, for workers' compensation, or for legal proceedings, it's not GST-free because it's not for treatment of that patient. Cosmetic procedures, they are excluded as being GST-free, so they are not GST-free if they are performed purely for aesthetic reasons. Even there, if the service is performed by a medical practitioner, cosmetic services are excluded. So GST applies on cosmetic services if it's purely for aesthetic reasons. So just to improve appearance and something superficial. For example, it might include tattoo removal or cosmetic injections or facelifts. If it's something for the appearance only, it's GST applies for this service. If certain procedures are performed for treatment of the patients, for example, a mole removal can be purely cosmetic, or it can be for treatment of that patient just to minimize the risk of cancer, for example, or if it gets in the way and the patient is complaining, and then it's GST-free. Medical examination. So in terms of medical examination, we need to consider who is receiving these services. If it's something for appropriate treatment of that patient, it's generally GST-free. For example, you might perform examination for the purpose of patient considering some high-risk activity, and because it's necessary to prevent certain health issues for this patient, it is GST-free. But when it's commissioned by someone, for example, like a regulatory body or a sports club or an employer, it's not GST-free. What about certain payments that your practice might receive from the government, for example, practice incentive payments or child immunization incentives? Are they GST-free? Well, they are not even considered to be supplies for consideration. So there is no supply in this case because you do not enter into any binding obligations to provide services. You do need to satisfy certain criteria, of course, to be eligible for these incentives, but there is no obligations to supply certain services. So there is no GST applicable to those payments. And moreover, they are not even included in your GST turnover. Yes, they are taxable, but they are not part of your GST turnover. And finally, I just want to quickly mention some other matters that require your attention. So if you have any of the following, make sure you discuss it with your accountant because there might be some problems with it. For example, if you have loans by private companies to shareholders or their associates sitting on the company balance sheet at 30th of June. So it will be sitting in the asset section of the company. And if it's a loan to a shareholder or their associate, you need to discuss it with your accountant. Now, if you have any unpaid present entitlement owing by trusts to company, you also need to discuss it because it might result in Division 7A issue as above. If you have any trust distribution to adult children or other low tax rate beneficiaries that remain unpaid or are applied for the benefits of other beneficiaries who might be in higher tax rate, then you need to address this issue as well because the ATO is tackling this arrangement and they regard this arrangement as being tax avoidance sometimes. If you have cars and other privately owned assets on the balance sheet of a company or a trust entity, it might not necessarily be a problem per se, but that means sometimes there is fringe benefit payable on the private use portion, or this private use might also result in Division 7A issues as above. So if you have any equipment leases, chattel mortgage or hire purchase arrangement, make sure you discuss with your accountant because you need to make sure you apply appropriate treatment for tax purposes. And if you paid lump sums to practitioners for agreeing to work in your practice, this is an area requiring specialist attention, so make sure you consult appropriately qualified accountant or tax advisor. And on a final note, I'd like to say that it's good to be proactive to tackle tax compliance issues. Don't wait until you are audited by the ATO or any other authority. Talk to your accountant. It's a good idea to review your compliance regularly, even if you don't identify any issues. Because qualified accountants, they are trained in these areas and they will be able to identify potential risks and potential issues for you. And if you have any questions in relation to content of this webinar, please feel free to contact us, to email us, or you can head to the website and make an appointment with me. So I offer 20 minutes free consultation. So if you have any questions about any of the issues in this webinar, please make an appointment with me. I will probably not be able to discuss any specific question as part of free consultation, but I will be able to answer general questions. And thank you for joining me for today for this webinar, and I hope you enjoy the rest of your day. Bye-bye.